Hello guys, welcome to Financial Markets FN211, and today I would like to talk about the basic central banking theories and monetary policies. When we talk about the monetary policies, we are mainly talking about the expectations management. Changes in the money supply will influence the changes in interest rate, and in the short run, changes in the interest rates also influence the economic activities. And today I will focus on the changes in money supply. And now we shall begin. And this is the outlines of the talk. For the first topic, I will deal with players in money supply process. The second topic is about the central bank balance sheet. This is opposite to last week's lectures because last week we talked about the balance sheets of the commercial banks. And the third topic is about the controlling of monetary base, multiple deposit creation, and the factors that determine changes in the money supply. And these are topics that we are going to cover for today's lecture. So alright, now let's analyze players in money supply process. The first player is the central bank. What is central bank? The central bank is a government agency that supervises the banking system. The central bank is responsible for the conduct of the monetary policy. In Thailand, the central bank is the Bank of Thailand. You can access to the Bank of Thailand from this website www.bot.or.th. And the second player is the bank or the depository institution. The depository institutions that accept monies from individuals and institutions and make loans. And remember last week we talked about the asset transformation. Examples of depository institutions or banks are commercial banks, saving and loan association, mutual savings banks, and credit unions. And the third player is the depositor. Depositors are those who deposit money in the bank. They are individuals and institutions. The central bank balance sheet shows the components of the asset side and the liability side of the central bank. The monetary policies and the operations of the central bank involve actions that affect its balance sheet. When we talk about changes in balance sheet, we are talking about changes in assets and liabilities. We will study the simplified versions of balance sheet because it is essential to the understandings of money supply process. So right, now let's turn to the liability side of the central bank balance sheet. As you know, the central bank issues banknotes. Currency in circulation is the amount of currency in hands of the public. Reserves. When we talk about reserves in the central bank balance sheet, we can imagine that the central bank is the banks of all commercial banks in the economy. All banks have an account at the central bank. Reserves are deposits at the central banks and physical currency that held by banks but liabilities to the central bank. Reserves are assets of banks and liabilities to the central bank. Banks can demand payment on them at any time, and the central bank has to certify the demand. Changes in these components also affect the money supply and in turn affect the interest rate. Assets are important for two reasons. Changes in assets lead to changes in reserves and in turn affect the money supply. Assets also earn higher income than its cost In fact, its cost is nothing. Assets can be divided into two subcategories. The first category is the security. The second is the loans to financial institutions. An increase in securities leads to an increase in money supply. Loans for financial institutions can be called borrow reserve. This is another way that the central bank increases reserves, and the central bank charges this rate from banking institutions. Now we will turn to how the central bank controls the monetary base. Let's begin by the definitions of the monetary base first. What is the monetary base? The monetary base, or high power money, equals currency in circulations plus total reserves. Here in this equations, MB stands for monetary base, C stands for currency in circulation, and R is total reserve. The central bank can control over the monetary base through its purchases and sales of securities in the open market. We call this process open market operations, or OMOs. When the central bank purchases of bonds, we call this process open market purchase. And when the central bank sells bonds to the public, we call this open market sale. I would like to make the explanation simpler. Let's think about bonds as the government papers, or just papers, normal papers. When the central bank buys those papers, we call this the open market purchase. The government will buy these papers back and inject money into the economy, and this will increase the money supplies in the economy. On the contrary, when the central bank sells these papers to the public, the central bank sells this paper in exchange for money. This can be thought of the central bank try to absorb money from the economy, the overall economy, and this will result in decreasing in the money supply. And now we will analyze the effects of the open market purchase on the balance sheet of both central bank and banking system. I would like to draw your attention to changes in the components of both central banks and the banking system. In this case, the central bank purchases 100 million of bonds from banks and pays for them with a check. The bank will either deposit the check in its account at the central bank. Remember that the banks also has the deposit account at the central bank, or cash it in currencies. Either action means more reserves. Reserves have been increased by 100 millions. The effects of an open market purchase on reserves depends on whether the sellers of the bonds keeps the proceeds in currencies or in deposits. However, monetary base is always the same whether the seller keeps the proceeds in deposits or in the form of currency. And now suppose that the central bank makes loans to financial institutions. We can see changes in the balance sheets of both the central banks and banking system. And here, as the balance sheet of the central bank, assets will increase by 100 million. And 100 million here will also increase on the liability side of the banking system in loans. Here, in the balance sheets of the banking system, suppose that the bank makes a reserves or deposits 100 with the central bank. We will have 100 millions of reserves on the asset side of the banking system, and this will be liabilities of the central bank. And now we will turn to the most important topic in this lecture, which is multiple deposit creation. Let's see. First National Bank. Suppose that the First National Bank makes loans to Bank A by 100 million. Loans from First National Bank will move to the liability side of Bank A by 100 million too. And in this situation, suppose that the required reserve ratios equal 10%. Bank A will keep 10% of 100 million, which is 10 million. 10 million will be total reserves on asset side of Bank A, and the excess reserve will be 90 million. Bank A will make loans with this amount. And you can see from the slide, we will have the arrow, the black arrow, that show the movement from loans from the First National Bank to loans on the liability side of Bank A. And now we will start from Bank A. From Bank A, we can see that with regard to the previous balance sheet, on the liability side, we have loans of 100 million. And then because we have 10% of the reserve requirement, Bank A will maintain 10 millions because it equals 10% of the loans and makes loans by the amount of 90 million to Bank B. You can see from this black arrow, loans move from Bank A to Bank B. And for Bank B is also in the same economic system. So Bank B also follows 10% of reserve requirement. On the liability side, loans equals 90 million. 10% of 90 million is 9 million. So on the asset side, Bank B will maintain or will keep 9 million, which equal 10% of the 90 million. This is the total reserve. And the excess reserves equal 81 million. Bank B will make loan from this amount of money. And you can see that this process iteratively occur throughout the economy.